So, what are some of the cornerstones that you need to look for in a new property purchase just to ensure that it's not going to end badly for you? Because it doesn't really matter whether you're adding to your portfolio for the second time, the third, or the 10th time, or you're in the position of making your first investment. Because it just doesn't really matter, because these insights will help you make an informed and strategic decision that helps you stick it out for the long haul. What I've learned is that winning in real estate is really about the time in market. And these tips will help you achieve that, starting with location, location, location. Now, the location of a property is one that's probably the most critical in terms of the long-term success of investing. And I know that you've heard this probably 1,000 times over, but it's because it absolutely matters. Over time, it can literally make the difference between years of wasted effort for no return or a shooting the lights out type of moment. If you don't believe me, I can literally point to properties that I would have looked at purchasing over 10 years ago that I can still buy today for the same price. You just don't want to be left holding that bag, and I didn't buy them because they were poorly located. But what does location, location, location actually mean? To me, it's about having a winning formula and a clear and well-defined process for identifying the right areas and suburbs to invest in, rather than sort of just a scattergun approach to investing anywhere because you read about it in a magazine or on a Reddit post or whatever. So when evaluating a potential investment, you need to make sure that it's located close to the proximity of things like the CBD in your particular state. More often than not, the closer in and the better and more established the area is, the better quality the asset will be. And what about the quality of the neighbourhood? Because I always look for places where families want to live and raise their children. And a lot of this comes down to the amenity of the area. The better the amenity, usually the higher the median house price for the suburb. And I also look for areas with good schools and hospitals and shopping centres, public transport and access to amenities like parks, because these types of areas typically have more demand over time, with loads of people just wanting to move into the area. I also look at the future development potential of the area. I research any planned developments, whether that's private or public in the area, such as new infrastructure or commercial projects or residential developments that can positively impact property values over time. And you've got to do your homework on urban growth areas as well. Where there is a large amount of land supply, well, typically you'll notice that capital growth can be a bit of a challenge in those areas. And it's a simple supply and demand factor. And then what about the economic stability of an area? Because this is an important component too. Typically, areas that have strong job markets and economic growth tend to have higher rental demand and property value appreciation. Remember that people always move to where the jobs are. And when it comes to, say, making an investment decision, you'll also need to think about the property type, the condition of it, and the age of it as well. One question I always ask up front is, well, does it have any land component? Remember, land appreciates while buildings depreciate, and in order of preference, you should always aim to purchase something that has a building with land. This will give you the best chance of capital growth. And second to that, townhouses are also okay, but closer to the CBD or the inner ring suburbs. And then lastly, apartments or strata units. These are least preferable given their lack of land and higher holding costs in the form of owners' corporations and whatnot. I just don't consider these to be great investments. I'd much prefer you to become the creator of dwellings such as townhouses or apartments. That's where you can really make some good money out of maximising the value out of that land purchase. I also factor in the structural integrity of the dwelling or building. Make sure that the property is really structurally sound with no major defects, and I always hire a professional inspector to assess the foundations and the roof and the mechanical systems and plumbing and electrical systems. A common point that a lot of investors tend to overlook is the maintenance needs of a property. Older properties in more established areas on larger land parcels will often make a better investment, but generally they also require more frequent maintenance and repairs. And you just need to factor in these potential costs into your investment decision and your feasibility study. Stuff will break, and the tenant is going to be looking at you as the landlord for the replacement or repair of those items. And then there's the renovation or refurbishment potential in a property. What does that look like? You'll need to determine if the property has the potential for value-adding renovations or extensions or redevelopment potentially. And then activities such as modernising kitchens and bathrooms or adding an additional living space or bedroom, these things can really help to significantly achieve a better rental rate and the overall asset value. We also need to talk about the rental yield and the cash flow. The old saying that cash is king might be a bit outdated, but cash flow is well and truly king. And you'll know this if you've ever been involved in any type of business or investing before. And real estate's really no different. If anything, it's more important, especially when you're leveraged with debt. Unfortunately for us landlords, the interest rate repayments don't pause just because the tenant stops paying. So understanding the financial performance of a property is really crucial for making a sound investment decision, and you'll need to look at the total rental income potential of the property. Most importantly, you'll need to ensure that it actually covers your mortgage, taxes, insurance and maintenance costs, and just any other costs that might be soaked up in the profit and loss. And then add in a bit of a buffer just to ensure that you've covered off everything that might come along unexpectedly. The best properties are those that are positively cash flowed and that put money into your pocket. This is typically where rental income exceeds all of the expenses and ultimately provides you with a nice financial cushion and just reduces your overall risk. There's no point paying $1 to save 30 cents on a tax break from negative gearing. From there, you can then start to calculate the property's gross rental yield, which is the annual rental income divided by the property's purchase price. A higher gross rental yield often indicates a better potential for return, but it all comes down to those expenses of running and owning the property. And then don't forget to compare your expected yield to other similar investments in other asset classes that carry similar risk, to ensure that you just spot the best place to park your equity. And then lastly, stay focused on market trends and real estate cycles. Watch these things closely because it's good to stay dialed in. It usually involves doing the complete opposite to what most others are doing in the market. And as Warren Buffett says, be fearful when others are greedy and greedy when others are fearful. In other words, be actively looking and be opportunistic when others are sitting on the sidelines. In property, knowing when to buy and when to sell is paramount because all markets move in cycles. Just like the tide comes in and the tide goes out, or the seasons change, or the days in a week, there is certainty about what happens next. And so to stay informed about these market trends and cycles and to make strategic investment decisions, you've always got to have a close ear to the ground and be asking questions like, what are the current market conditions? What are people feeling in the economy right now? Are markets hot? Are people flying financially, or is there hurt and pain out there? Learn to analyze whether the market is in a growth phase or stagnation or potentially in a decline phase, because this will help you, to time your investment decisions for the maximum returns possible. And look, you'll never be able to pick the bottom or the top, but the important thing here is just to ensure that you're in sync with the market. You should always consider the long-term trends in an area too, such as the population growth, the net migration, unemployment rates and housing supply or undersupply, because these types of economic indicators can provide you with wonderful insight into what a market may or may not do. And just keeping tabs and a keen eye on things like interest rates and inflation and other government policies that can impact the real estate market could make a really big difference to whether you're a buyer or a seller or potentially a holder. The monetary supply is often what expands and contracts a market. It's all relevant to the supply of credit. When credit is easy, market speculation pushes prices up, and the opposite is true as well. And this is all predicated on what the medium to long-term trend of the RBA's cash rate decision-making process looks like. So there you have it. There's a few things for you to keep in mind next time you're looking to buy and add that next property to your portfolio. I hope that helps, and I'll see you on the next one.